September 15th, 2008. It was 1:45 in the morning inside the Lehman Brothers headquarters in Times Square, and the CEO, Dick Fuld, stood alone on the 31st floor, staring out over Manhattan. Below him, news vans were lining the streets. Camera crews were adjusting tripods. Reporters were gathering as if waiting for a verdict. In a matter of hours, one of the oldest financial institutions in America, a firm that had survived the Civil War, both world wars, the Great Depression, and countless market crises, would declare bankruptcy. It would be the largest in American history. $639 billion in assets, $619 billion in debt, 25,000 employees about to lose their jobs, and the global financial system preparing to unravel. What was about to happen wouldn't just sink a bank. It would ignite the Great Recession, the most devastating economic crisis since the 1930s. But the important thing to understand is that Lehman didn't collapse because of misfortune or some unforeseeable disaster. It collapsed because the system around it was built on hiding risk, rewarding recklessness, and shifting consequences from those who made the decisions to everyone else. And that system didn't disappear when Lehman went under. It grew. To understand how Lehman Brothers could rise for a century and a half, then fall in less than a year, you have to go back to where it all began. The firm started in Alabama in 1850, when three German immigrant brothers, Henry, Emmanuel, and Mayer Lehman, opened a cotton trading business. After the Civil War, they moved to New York and turned their operation into an investment bank. Over the next 150 years, Lehman financed some of America's most iconic companies. They helped take Macy's public. They backed startups during the tech boom of the 1990s, and by the year 2000, Lehman had become the fourth largest investment bank in the United States. But by then, the world was changing. Their traditional business, underwriting IPOs, advising mergers, managing client portfolios, was steady but dull. And after the dot-com bubble burst in 2000, revenues dropped sharply. Lehman needed a new strategy. They found it in real estate. Starting around 2000, Lehman dove aggressively into mortgages and mortgage-backed securities. They bought mortgage companies, packaged mortgages into large financial products, and sold them for enormous profits. By 2004, they were one of the biggest players in the housing market. The profits were staggering. By 2006, Lehman earned almost $4 billion in a single year, and Dick Fuld became one of the highest-paid executives on Wall Street, taking home over $40 million annually. But the reason the profits were so big was because the mortgages were increasingly dangerous. The housing bubble was inflating fast, driven by extremely low interest rates. After the Fed slashed them to 1%, following the dot-com collapse, borrowing became incredibly cheap. Home prices soared. People borrowed more because rising prices made them feel wealthier, and banks, running out of qualified borrowers, pushed deeper into subprime loans. These were mortgages given to people with unstable incomes, weak credit, or no down payment. Some borrowers had no job, no income verification, no assets, so many. In fact, that bankers created a nickname for them, ninja loans. But the lenders didn't care if the borrowers could repay, because they sold the loans the moment they were signed. Investment banks like Lehman bought those loans, bundled them into securities, and sold them around the world to pension funds, insurance companies, foreign governments, anyone chasing high returns. The rating agencies stamped these products with top-tier ratings, claiming they were safe as government bonds. The truth was that the loans inside them were junk, but the system worked as long as housing prices kept climbing, because rising prices hid the risk. That illusion lasted until 2006. For the first time in modern history, home prices started falling nationwide. Subprime borrowers began defaulting. Adjustable-rate mortgages reset to payments borrowers simply couldn't afford. And foreclosure rates exploded. Warning signs started flashing everywhere. New Century Financial, a massive subprime lender, collapsed. HSBC announced huge losses. Hedge funds tied to Bear Stearns blew up. European banks froze withdrawals because they couldn't value the mortgage securities in their portfolios. Credit markets seized up. Banks stopped trusting each other. Lehman publicly reported record profits in 2007, But behind closed doors, panic was spreading. The firm was sitting on more than $85 billion in mortgage-backed securities and CDOs, much of it toxic. Risk officers warned leadership repeatedly, but their concerns were brushed aside. Eventually, the chief risk officer was pushed out of the way entirely. In March 2008, Lehman watched Bear Stearns crumble. Within days, Bear went from being a major investment bank to a near-bankrupt shell. And then something crucial happened. The government stepped in. The Federal Reserve helped engineer a rescue, funneling $30 billion to support J.P. Morgan's takeover of Bear Stearns. Dick Fuld saw that bailout and assumed that if Lehman ever ran into trouble, the government would be there too. He believed Lehman was simply too big, too interconnected, too important to be allowed to fail. That assumption would turn out to be fatal. Over the next 6 months, Lehman tried to raise capital, sell assets, or find an investor, anyone willing to stabilize the company. But each time potential partners studied Lehman's books, they saw risks and losses hidden behind accounting tricks. No one wanted to take the gamble. By September 2008, Lehman was out of time. Its stock price was collapsing, its lenders were getting nervous, and the firm was leveraged 25-1, meaning for every dollar it actually owned, it had borrowed 25 more. When you get leveraged, even a small drop in asset values can destroy you. That week, Fuld scrambled to find a buyer. Bank of America looked briefly, then walked away and chose to buy Merrill Lynch instead. Barclays was interested, but regulators in the UK refused to approve the deal unless the US government guaranteed Lehman's losses. Treasury Secretary Hank Paulson refused to provide that guarantee. He was under intense political pressure to avoid another bailout after the controversial rescue of Bear Stearns, and he had decided that Wall Street needed to absorb the damage itself. That decision sealed Lehman's fate. On the night of September 14th, the board met, and before dawn on September 15th, Lehman Brothers filed for bankruptcy. 158 years of history disappeared overnight. The fallout was immediate and devastating. Lehman wasn't just another bank. It was deeply connected to the entire global financial system through hundreds of thousands of contracts. When it collapsed, nobody knew who owed what to whom. Markets went into free fall, credit froze, the Dow plunged. Companies couldn't borrow money to make payroll. AIG nearly collapsed the next day because it had sold insurance on mortgage securities and suddenly faced impossible losses. The government rescued AIG immediately, just 24 hours after refusing to rescue Lehman. Money market funds broke the buck. Investors panicked. Over $300 billion fled these funds in a single week. Banks around the world teetered on the edge of collapse. Paulson and Federal Reserve Chairman Ben Bernanke rushed to Congress and said, flat out, that without government intervention, the financial system would collapse within days. ATMs might stop working. Businesses would shut down. The U.S. could enter a depression. Congress initially rejected the bailout. The stock market crashed again, and then shaken they passed the $700 billion TARP program. But even with massive intervention, the damage was unavoidable. Countries like Iceland saw their entire financial systems collapse. Europe faced huge losses. Global trade shrank at record speed. 8.7 million Americans lost their jobs. $16 trillion in household wealth evaporated. It took years for employment to return to pre-crisis levels. Then came the hunt for blame. Dick Fuld defended himself before Congress, claiming short sellers, the government, and the media had destroyed his company. But the deeper truth was that Lehman had built its business on unsustainable risk, disguised losses, and ignored warnings. Regulators failed. Rating agencies stamped toxic securities with top ratings, and every major bank had taken similar risks. Lehman just toppled first. After the dust settled, not a single major executive from any of the big banks went to prison. Some firms paid fines, but the people responsible kept their wealth. Meanwhile, the surviving banks only got bigger. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America absorbed Merrill Lynch. Wells Fargo took over Wachovia. The very problem that made the crisis so dangerous, that banks were too large and too interconnected, became even worse. Today, the 4 largest U.S. banks control more than $10 trillion in assets. Despite new regulations, lobbying has weakened oversight. Leverage is creeping back into the system, and major risk pockets are forming again, especially in commercial real estate, where over $1 trillion in loans are coming due in the next few years. The same forces that destroyed Lehman, excessive risk, oversized institution, and faith that the government will step in, are still very much alive. Lehman's collapse should have been a turning point, a moment when the financial world recognized how fragile and dangerous the system had become. Instead, it became a warning that was quickly papered over with government guarantees and central bank money printing. Everything that happened on that September weekend wasn't just a story about the past. It's a preview. And the real question is whether anyone is paying attention this time.